Welcome back to the Good Success Podcast. I'm your host, Josh Culler. Got Tom Olson, president of Good Success, sitting right here next to me.
That's me.
We're in a little bit of a different format today, but it's because we've got somebody in the house, which is Josh Belk in the flesh in the studio. We had you here about this time last year, but we were in like one of the back offices and not in the studio. So hopefully it's a little bit of a
nice and cozy.
Like it's
sure.
nicer here.
Yes.
You know, last time we had like a gray backdrop behind us and everything, so it was a little weird. But so we're gonna talk about
incremental steps.
We're
Slow
incremental, right?
Steps until we get to this nice studio we're gonna have.
That's
here.
exactly
Yes.
right. And we got sponsors like that are going to be coming online, and so that they're going to help us with getting
excited about that.
Better experience and everything, better equipment and all that, so that we can make these podcasts even better. So today we're going to talk about tax.
It's already
stuff.
the best podcast.
It is the best podcast.
It's already the best podcast, but we're just trying to make it better.
We're going to make it better. There's always room for improvement, right?
That's right.
So today we're going to talk about. So Josh is a CPA, Belk & Associates. And we're going to talk about tax stuff. Now, that doesn't sound exciting. We always like, make that joke at the mastermind and everything. But Josh always does a great job of bringing information that's relevant to not just business, but real estate investors as well. And I'm sure you'll talk about your business and how many clients you have as well that deal with real estate. And I know you're way up there now. But we're going to talk about opportunity zones, which Tom's excited about. That was one thing Tom's like, we need to talk about that right now.
I like opportunities.
Opportunities. So
I love opportunities.
Is that
in opportunity zones? Have opportunities.
Is that philosophy or is that
yes,
physical?
Yes, it's both.
Okay.
It's both. It's both.
Just what it is.
I will always tell everybody, if you're going to get into real estate, you have to have 3 key people on your team outside of like the actual team members you have in your office.
Support.
You have to have a great accountant that doesn't just understand accounting, doesn't just understand how to do your taxes at the end of the year, but understands how to do real estate accounting. It's a completely different thing and it's a completely different animal. So you must have a real estate accountant. You must have a real estate attorney. And you always want to make sure that you understand insurance as well. So outside of the realm of understanding how to do a deal, you want to make sure you can protect yourself from a liability standpoint and from insurance as well. But you always, so that's kind of like your attorney. Is they're always there that you can kind of bounce ideas off of, get advice from, make sure your contracts are done properly. And he's going to be the one that's going to stand behind you in court if something goes wrong or you do something wrong. Have a good accountant that can help represent you to the IRS, and then make sure you have a really good insurance agent on the back end that can also help protect you and when things go wrong. So that's why Josh is here. That's why he's part of the Good Success Network. He's going to be speaking at the Community Go-Giver event like he had us for last year. So we're excited about that. But Josh is one of my key people that I reach out to on probably a weekly, monthly basis type and ask him, bounce things off of him. And if you don't have somebody like that, you should have somebody like that.
Absolutely. And not to mention that he's your brother-in-law.
That's true. So... And I mean, and honestly, you can't always work with family, but it works with Josh because he's a humble person and does a great job, kind of being able to take himself out of a situation and not just look at it from his perspective, but from an investor's perspective as well. Josh is great too. He actually has a couple of years of law under him as well. He's not a lawyer. Didn't actually complete that, but he has, I think, a year and a half, 2 years of law school. So that actually, I think, really helps in the realm of accounting, because a lot of times your accountant and your attorney look at things from the exact opposite end of the spectrum. And to have somebody that kind of understands both, it really does help. Which actually even helps Josh. Josh has helped work with us with Doug, our attorney, sometimes, and has helped us, figure out things, because Josh kind of understands both sides of the coin and trying to make sure we protect ourselves, but also take advantage of the taxes as much as we possibly can too.
Absolutely. So with all that being said, we have a lot of great information that's going to be coming out of this show. So you guys, make sure you stay tuned. Write a lot of notes down, because you're going to get hit with a lot of information.
Is it okay, Josh, if we share this?
Oh, of course.
PDF, so we can share this at the link
sweet.
below. So if you guys are on Facebook, you guys can just go down. We'll put this as a PDF in one of the comments. And this is just kind of an overhead, but there's a lot of value here. You guys should probably pay a lot of money for this.
Yeah. Are we trying to monetize it again?
I think we should. I think you should pay for the PDF.
But we gotta give him royalties.
We're going to give this for free.
So awesome. Well, we appreciate you doing that. So I guess what we'll do is, if you're listening on the podcast, just email me jcolor@goodsuccess.com, and I'll make sure that we get this over to you, and we appreciate that. So Josh is with Belk & Associates right in Crown Point, or St. John, Indiana, over there on 41. And he's also a part of our mastermind. So the Good Success Mastermind, he's been with us since the second quarter of 2017. It was your first event that you were with us. So we definitely appreciate him being there. And you've had perfect attendance since then, right?
Right.
Is that correct? So that's awesome stuff. So maybe we'll be honoring you in the next event, because that's our year up coming around. So all right, well, great stuff. But before we get into it, if you guys haven't already, make sure you have subscribed to the Good Success Podcast. We're on all the podcast platforms. Just go search for us and you will find us there. And then if you haven't already, make sure you leave a 5-star review. Would be much appreciated from you. Apple Podcasts is a place that you can go do that. Just go over to Apple Podcasts, go to our little page there, and then leave a review. 5 stars would be amazing, and we would much appreciate that. And then the Good Success Mastermind, like I mentioned, Josh is a part of the group. Josh, what do you think of it? Good. I mean, you're still in there, so.
Right. It's absolutely phenomenal. And not just, of course, it's mainly real estate investors in the room, but there are a few of us in the room that actually provide kind of support services. But regardless if it's Good Success or another mastermind, got to get yourself in one. And I know for myself, and kind of walking through this, and of course, most of our clients are in the real estate space, but just being pressed by those in the room to take steps in my own business, and not just in the business side of things, but also on the personal side of things as well. To kind of, and it really kind of brings those worlds together, helps you bring those worlds together, and it's just not about making money, but also finding, in the case with Good Success, true success, not just in the area of your business, but also in the area of your personal life. We've even gotten into spiritual side of things, the physical side of things, but just kind of really just being a whole, complete person as it relates to success.
Awesome. We definitely appreciate that. So if you guys want to learn more about the mastermind, the next event is February 4 through 8. Are you going to be in group 1 or 2?
Group 1.
Group 1. So you'll be there at the beginning of the week. So we're going to get to see Josh there. 4 through 6 is his dates. But the event is an entire week. We're splitting into 2 groups and then meeting on the middle day. Both groups are going to be on the middle day. And that's going to be in Dallas, Texas, over at Quest Trust Company's office down there, and they're going to be hosting us. Quincy Long and the team down there is going to be hosting us there, and they're kind enough to do that. So if you guys want to learn more about it, go to goodsuccess.com/mastermind, fill out the application there, and then you'll get on a phone call with either myself or Tom, and we'll vet you by the core values that we have. And I think that's one thing that we've definitely taken pride in, is the culture that we've built there and the type of people that are there and focused on the type of success, the quality of the success. And our core values really stand for that: community, stewardship, growth, and charity. And that's how we kind of vet you. Of course, your business, of course, what you're doing in your business, the amount of deals you're doing, and all that stuff, but also the type of person you are. So one more time, goodsuccess.com/mastermind is where you can learn more about that. And then the Active Turnkey book, the best way to buy rentals. We've announced this is going to be going away. So January 1 is the cutoff day where you can get this for free. So all you have to do is go to atkbook.com. Tom's going to be paying for the book. All you got to do is cover shipping and handling costs. So make sure you take advantage of that. You're technically, well, I guess, I don't know. You're technically paying for the book. You might be. Yeah. Technically. So I don't know. Maybe that's a question for you, our accountant. But you guys can take advantage of that. Make sure you do. One more time, atkbook.com. The deal ends January 1st. This will still be available on Amazon. So if you go to Amazon, you'll be able to find it there. But it's $14.99, so save some money. I mean, you may get free shipping with Prime, but you're still going to be paying less for the shipping if you do the free offer. So make sure you take advantage of that. One more time, atkbook.com is where you can do that. And then the Community Go-Giver event, a lot more details to come. But Josh, like we mentioned, Josh actually spoke at our July event, our first Community Go-Giver event we had this year. And then he's going to be coming back for our 2019 event in June 26, 27, 28. We have an incredible lineup. We just recorded a podcast with Jim Ingersoll yesterday. That'll be going out pretty soon. So he'll be there as well. That's exciting. So you guys be on the lookout for more details about that. CommunityGoGiver.com is where you can get early bird pricing tickets right now. Save a couple $100, and then you guys can come visit us there. So Tom, do you want to talk about this at all?
The only thing I'm going to say is, on the spot, I'm going to ask Josh if he will actually talk about opportunity zones at that event. I think that's one thing that by June of 2019, like you better be making sure that you understand what you're doing, because I think you're only going to have until end of 2019 unless they extend this. But Gary, half of Gary, Indiana is an opportunity zone. And if you guys know me, I'm trying to flip the city of Gary. And part of that has to be like the opportunity zone opportunity that is here in Gary, Indiana. But if Josh planning on having him talk on opportunity zones and how to take advantage of them, how does it really work, and how to be able to structure your fund or your type of business to be able to take advantage of it, either from a business standpoint or from the housing standpoint, owning housing, for 10 years or so. We'll probably talk about a little bit of that today, but being able to have him here for the event, be able to shake his hand and be able to ask him more questions, that might pertain particularly to your situation, I think would be a great value to you guys to come just to hear how to take advantage of opportunity zones. So like I said, every one of our speakers is probably worth the admission to come, but and I think that's the case here with Josh. So if you could just learn how to save $10,000 on one transaction, it's probably worth your $699 to come and see us at the Community Go Giver event.
Awesome stuff. So communitygogiver.com is where you can pick up your early bird priced tickets right now. And
how much is early bird prices? We say early bird, but how much is that?
I think it's
you
just put me on the spot. I
know. I know.
It might be. It's just under $700 for one ticket, I believe, for one general admission price ticket. Okay. Maybe Emily, if you want to go to the website real quick and let us know what that is, that'd be great. So
we should probably be saying that. Maybe
we should be saying what the prices are.
What it is right now, and it's going to go up. This.
So as soon as she gets that, let me know, and then we'll announce that. But let's go ahead and get into this interview. Josh, so do us a favor, introduce yourself, who you are, what you do, how long you've been doing that, and then if you guys didn't already, last year we actually recorded a podcast with Josh. I don't remember exactly what episode number it was, but it was one of the first times we actually had an interview with somebody. So Jim Ingersoll was our first, and then it was Josh. So that's awesome. So it was a long time ago.
It's like 100 episodes ago.
Yeah, exactly. So some great stuff. So you guys go back and listen to that, and there might be some information in that podcast that is irrelevant now, or
a lot of it. Well, actually, a lot of it, but there's quite a bit of it that we have a great deal of clarity on,
which we're going to go over today.
Right. Yeah. Exactly.
Awesome stuff. So, introduction.
Okay, Josh Belk, Belk & Associates. I think Josh did a good job as far as explaining who I am, but own an accounting firm in St. John, Indiana. We have somewhere 700-800 clients on our that we work with, and a great majority of them are in real estate in some form or fashion. So it might be an individual that owns a few rental properties to clients that own hundreds of properties or wholesale hundreds of deals a year. And it's just kind of naturally become our niche through the years as far as clients in that particular space. And of course, we have clients across the spectrum, enjoy working with different types of clients. But really, just because the tax realm becomes so complicated, you really can't try to become knowledgeable in everything. You'll get yourself in a lot of trouble. So really trying to find an area that you focus in, you do well, and that's the approach that we've taken, and really enjoy not only as far as working with taxation and accounting, but especially working with real estate investors. A different type of a culture, different type of a community, but a very enjoyable group, an exciting group to get to work with. And I love what I do and do what I love, and love the people I get to work with, and including you guys, and the opportunity that we have to get to work together. So,
that just hit you, Josh.
That's sweet. That's really sweet.
This is where you got to come in after and do that little voice edit. Right.
We need to get one of those clicker things that Scott Carson has.
Yeah, we should get some noises. Yeah, it'd be great.
Awesome. All right, so let's talk about some tax information. So one of the first things that we have here is an overview of the Tax Cut and Jobs Act.
Josh, you say that like tax is so exciting.
It is exciting.
It is exciting.
I have to pump it up.
If you're smart, I think tax actually is very exciting because
it is.
You can make more money by saving money in tax sometimes than you can make more money. So
absolutely,
definitely pay attention to your tax rates.
So let's talk about it. You have a little bit of an overview, some things that you said maybe updated and a lot more clarity on. So hit it with us.
Sure, I'm just kind of run through this, and tax, and Tom hit on it. I mean, it's kind of one of those things. It's not always exciting as far as trying to learn, and for somebody like myself, I spend a lot of time reading, and I don't know how many times I've taken a snapshot of an article and sent it to you, or a link, whatever the case may be, as I do with a number of my clients when we're dealing with a particular area. I love having educated clients. To me, I love it when a client texts me, when a client asks questions that they're trying to learn as well. Maybe they hear something somewhere, because I don't have all the answers. Nobody in my space does. So you may go somewhere, hear something, and that may trigger, hey, is this something we can do? Is this something that we can implement? And
I think that should be the quote, Josh. I don't have all the answers. Nobody in my space does. Josh Belk, accountant.
There you go.
Well, and a word that there's some words in the English language I cannot stand. Fair is one word I do not like at all. Another one is the word expert. As soon as I hear the word expert, I'm like, I'm turning on something else. So, when they self-proclaimed expert, because or guru, any of those types of words, right? Because there's always plenty of people out there a lot smarter than we are. I think of John Heyer and John Groom, these guys who have forgotten more in my space than I know. I mean, it's just so finding those people and learn from them. And as Tom spoke, have people in your network that are there to help you. But anyway, getting back to the actual issue at hand here, as far as with the actual act that was passed late last year. And if you go back to the prior podcast, we kind of went through at a high level because there were some areas that had not been cleared up yet. Sure. So I'm going to try to hit on those. I'm going to kind of run through at a high level just kind of what some of the changes were that kind of affect everybody. And then we'll kind of maybe dig in just a little bit more into those areas that we didn't have clarity on, especially as it relates to real estate investors and beyond that, business owners in general. So if you're out there and you're watching this, you're not necessarily in the real estate space. I think there's going to be some information here that'll be helpful to you. And this information, I have to say this, my attorneys like when I say this, but it is informational purposes only. I'm not giving tax advice per se. So please go and consult your own accountant, your own attorney, and make sure that that whatever you do, it fits your situation. And I can't stress that enough. Get those people involved in your network. Get them involved in your business. They're there to help you. At least if they're the right person, they are. They're there to help you, and they want to see you succeed. Right. So the Tax Cut and Jobs Act was passed by Congress late last year. Basically, it was an attempt to kind of just lower taxation and to also really kind of bring some infrastructure, some money into infrastructure into our economy. And I think the opportunity zones that we'll talk about here in a little bit is one of the really focused efforts that try to do that. The U.S. does have the highest corporate tax and tax structure overall of any country in the world. So when the tax law passed, expected GDP growth from this act was supposed to be 1.7% in the long term, and wages were to increase about 1.5%. Or in 2018, year-to-date growth GDP is actually at 3.5%, and the wage increases aren't quite to where they expected them to be at just under 1 percentage point. So, the average taxpayer is seeing about a 1.1% increase in the amount of money they take home that they see coming in.
So for every $100 we make, we get to keep one more dollar.
You get to keep another $1.10 on every dollar because of the right, and it's not huge. The average family affects them $400, $500, $600 a year. But for some people, that's a rent payment or something that might be there to help them. So and for those who are knowledgeable, they're gonna take this. They're gonna see what's there for them, and then especially if they own a business, maybe some things that they can do to kind of help overall minimize their tax exposure. So who does this affect? It affects different types of income in much different ways. So the individual, you're seeing, and I'm going to kind of just steer away from these notes here a little bit. So for the individual, you're seeing basically it was effectively a doubling of the standard deduction. So it's $12,000 for a single person, $24,000 for a married person. So before, about 70% of taxpayers used a standard deduction. Now you're going to see that number probably somewhere right around 90%. We'll see how that plays out this next year. You saw a lot of changes as it relates to itemized deductions. So kind of all these 2% miscellaneous deductions were taken away. So the unreimbursed employee expenses is one area that was taken away. It affects certain individuals like pilots and truck drivers and people like that. Affects them unfortunately in a negative way. But overall, I think it helps most people, your average taxpayers in a positive way with this particular change. The state and local income tax deduction now is capped at $10,000, where before there was not a cap on it. So if you live in a high tax state, such as like California or next door to us here in Illinois, it's going to affect taxpayers there, kind of in a negative way. But for here in Indiana, being in a more tax favored state, for most of our clients anyway, a great deal of them will still be able to use, if they do itemize, still use most of their state and local income tax as the deduction, but that's been capped at $10,000. The individual exemption for the alternative minimum tax, that has been increased. And I've seen that affect more and more my clients. I think, Tom, it affected you last year in a negative way. So we kind of go through and we sit down and we look at a tax return. And for higher income individuals, you start to see certain phase outs of certain things. And then you have this alternative minimum tax, which you need a PhD in whatever to try to even understand how that thing works and the calculations on that. But basically, it's an alternative way of figuring taxes. And it unfortunately affected a lot of really people it wasn't meant at all to initially affect. And those were people, making, a couple $300,000, which is still kind of just middle class, but it's really affecting a lot of those people negatively. And so that particular income level has been increased, so not as many people will be impacted. The child tax credit is now $2,000 per child. The individual exemption was removed. And so, so a married couple up to $400,000, they'll be able to take the full $2,000 credit per child that's under 16 and under on their tax return. And they in one area that was repealed was the DPAD. So the domestic production activities deduction, which is Section 199, that affected most of our clients that were in the real estate space that did any sort of purchasing a house, fixing it, and reselling it. They were able to take the DPAD. That's been repealed, and now it's been replaced by Section 199A, which we'll talk about here in a minute. C-Corps, we have this flat income tax rate now at 21%. So instead of the staggered rate, we see the 21% removal of the corporate AMT, lowering of the dividend received deduction rate, and probably for most people listening, and even most of our clients, this does not affect. And then the repatriation tax, there was some work done there to try to help bring cash and assets back here into the U.S. that were overseas. So instead of penalizing companies for doing so, it kind of lessened that particular burden. So pass-through entities, which probably for many of you who own businesses that are listening to this, you're going to have these pass-through type entities. So you either have a partnership, you have an S corporation, you have an LLC taxed as one of these, and so you see basically your net income from your business that flows through to your individual income tax return. So these pass-through types of entities. So some changes we saw there. Business entertainment is no longer deductible. So now it's just a meal side. There were some changes, and those changes really affected larger companies. But there were some changes that relates to the deductibility of meals. So be aware of that if you're a business owner. I just had a phone call this morning, actually come into my office. Hey, Josh, we're having some people come in. How do we handle meals now? And so there is some changes there. You want to be aware of the handling of the meals deduction, but entertainment. So if I were to take Tom, or if I were to take you, Josh, to a Bulls game or to a Bears game, whatever, not able to do that and deduct it anymore. Right. So, but the meal side for the most part has stayed intact, but there has been some small tweaks there.
So you kind of have this on this sheet, at least. You have it under the pass-through entities section. What if that's done in the C-Corp environment? Does it
basically went across the board. Okay. So even if you're an individual acting as a sole proprietor, so I have it under there, but it's just some kind of affects people that have a business of some sort. But so that affects everybody. Sure. That the changing of the meals and entertainment.
Now, if somebody, so for instance, at the mastermind we have our sponsors. If somebody's sponsoring an event that's an entertainment event, does that count with this because it's a sponsorship?
It's a sponsorship, so generally that would be booked as advertising.
Gotcha.
So you're going to go through and book that on as advertising, but talk to your tax advisor.
Sure.
And a lot of it depends on what's being done too. So when you talk about paying for alcohol, things of that nature, you're really starting to run into some issues there. So, but generally, if you're going through and you're sponsoring something, that generally is an advertising promotion expense. Okay. There's basically doubling of the Section 179 deduction, so that's full expensing of an asset in a given year in certain depreciation classes. So and then we see bonus depreciation also in those classes go from 50% to 100%. So what we're happening historically. So say somebody goes and they buy say a computer, for example. They would go through and it'd be 50% deductible. Now there can be an acceleration of full 100% deductible in a given year. So there are certain items now that can be fully deducted in year one. So let me kind of briefly, and this gets extremely complicated, but get into this qualified business income tax deduction. So we talked about the repeal of the DPAD. So that was the domestic production activities deduction. And so that's gone away. I think actually maybe in the first or second mastermind actually spoke on this. Mm-hmm. And then they repealed it about a month after I talked about this at the mastermind. But so that deduction is now gone, and now we see this qualified business income tax deduction, which last year when we had this conversation, we weren't quite sure. The qualified business activity wasn't even defined yet. We didn't even know what type of activity would qualify, what types of activity would not qualify. But here, a couple months ago, they finally came down and brought us clarity as far as, okay, what is and is not going to be considered an activity that can be used for this particular deduction. Some things we did know. For example, as an accountant, some people in the health profession, attorneys, people that basically rely on their own kind of their skill or trade, professional skill or trade with a license, most of those areas cannot take this particular deduction. So for somebody like myself, this does not necessarily affect. Okay, but for most of our clients, it does. And so what is a qualified business income, qualified business activity? What is that? And so basically it's an activity for income or profit in which the taxpayer is involved in the activity with continuity and regularity. That's the definition. So something that they're doing for a profit. So it's not a hobby. It's not something that they do passively. Okay, so something that they're actively involved in order to make a profit, with the intent to make a profit. And of course, I mentioned there are some exclusions, some areas that aren't able to take this. So this particular deduction applies for anybody who's doing that type of an activity, and then if they earn up to $315,000, they can take this 20% full 20% deduction. And then it begins to phase out between $315,000 and $450,000.
So what's the 20% based off of the net profit?
The 20% is based off the net profit. And so when you look at the net income, basically, if you're under the $315,000 threshold, it's going to be 20% of the net of the net income of the business. Basically, if your business makes $100,000, okay, you're going to pay tax on $80,000. Just kind of oversimplifying it. If you're under that $315,000 threshold, once you get above that, there's these other triggers that begin to come into play. So there's an element of how much W-2 wages you have, and then or 25% of your W-2 wages plus 2.5% of the capitalization cost. So it's going to get a little bit complicated. And so if you own a business, I kind of strongly encourage you not to try to tackle this stuff alone. And there's going to be a lot of kind of working through, even in my space, for us accountants, to try to work our way through all these. And then not only that, but also some of these gray areas on what is and is not an active activity, a qualified business activity. We think of, for example, rental properties. Now, properties are, being in the world of real estate, that isn't active for the most part. If you're doing it day in and day out, it is it is active income. Okay, but we think of rental properties, for example, which is generally a passive income activity. Now, if you're actively involved in rentals and you're actively managing it, it could qualify. But if you're not actively managing it, then at that point it's passive income. You may not qualify, probably would not qualify for this particular deduction. So these are things you need to look at. Other things you need to consider doing is if you have a kind of a portfolio of properties that you have some active rentals and you have some passive rentals. So some properties that you do self-manage, you have others that you do not manage. Okay, you're going to want to make sure that those are peeled away. So your bookkeeping is going to become huge. It's going to become more important than it ever has before, because you're going to have to be able to identify by property. Okay, what was my income for that property? What were my expenses for that property as it relates to this particular deduction? For businesses that have multiple types of income streams, same type of thing, you're going to have to be able to peel away those particular elements in your books between what is active versus what is not active, what does qualify and what does not qualify. So hopefully your accountant is up to date on these things, and then also is working with you. And I know for most of our clients, we're regularly, even if they don't know it, we're regularly hopping into their books, kind of taking a look at things. Sure. Are things being done? And I think, Tom, you can attest to this. I send you a text message, hey, doesn't appear that something's being done. And so, so I'll go to my client and say, hey, maybe it's something maybe we need to take a look at, something we need to consider, that when we get to year end, we get to the point of trying to prepare tax returns, we have the best possible, we can deliver the best possible product, give our client the best possible result that they're looking for. So I don't want to spend a whole lot of time getting into the nitty gritty on this, but just simply be aware, if you're listening to this, that this deduction is out there, and you should be having a conversation with your accountant on how does this affect you. And then we're bumping up here to the end of the year, so it's something you want to get done quickly. But your bookkeeping element, and once again, I had a phone call with a client this morning. I think they've gone through 3 different bookkeepers this year, and kind of things are a mess. And they reach out to us and say, help. And it's an issue. A lot of businesses really struggle trying to find somebody that knows how to kind of how to get their books in a place to where they can get the best possible result. So reach out to your accountant. In my office, for example, we actually, we'll go in next week. We'll spend an entire day at a client's office trying to get stuff cleaned up for them, trying to train their staff, trying to give them some helps, and even some of that can be outsourced. But whatever you do, it's just bottom line, just make sure that your bookkeeping isn't being neglected, that things are being tracked well, because you need to know your numbers as a business owner. But beyond that, also to where that information can be taken and deliver the best possible result as it relates to your tax return.
Well, I mean, all that stuff is great, and yes, you should do all that. But I guess what the listeners probably want to know, and what I want to know, is how do I take advantage of the new tax law? Like, what things should I be doing to take advantage of this? Yes, I need to have a good accountant, but what are maybe some things that maybe I should be considering?
Well, as it relates to this particular deduction, you need to kind of take a look at where your income level is at. If you're under $315,000, there's not really a whole lot additionally that you need to do. Okay, so you continue focusing on your business and what you're doing. Just realize that tax break is there. Okay, so there's nothing really that you need to tweak. If you're over that $315,000 threshold, so that's something you should understand. Am I between that $315,000 and $450,000? If you're married. So if you're in that particular zone, if you're in that particular area, then there are things you do need to look at. Okay, you do need to look at your payroll, because that's an element of it. So if you have an active business and say you're $350,000 and you have no payroll and you have no assets being purchased, your deduction is not going to be there for you. Okay, so you need to make sure that those elements are there. So if you're in an S corporation environment, and for compliance purposes, you're supposed to draw a paycheck as an owner. And sometimes we'll see that people come to us and they have these S corps and they don't have payroll all year. Then they come to year end and trying to prepare a return. And if they're in this zone, now all of a sudden they've lost this particular deduction. So you need to take a look at, if you're in that between that $315,000 and that $450,000, you'd be taking a look at your assets being purchased during the year, and then your payroll. And so you want to make sure, because it's going to be a comparison of that 20% of your net income versus 50% of your payroll cost, or 25% of your payroll cost plus 2.5% of your assets that have been purchased, of your basis in your assets. Okay, so that's where the tax planning aspect comes into it, and it's a delicate balance, is to kind of look at those things, and but to make sure that not only for compliance purposes that they're there, but also for the tax deduction.
Should clients be considering maybe a C-Corp to add to their portfolio of businesses, maybe, or something?
Definitely. I mean, if it's kind of one of those things, if you find yourself in a higher income tax bracket, for example, and you have a business that you're not looking to try to pull cash out of, because the biggest downfall of a C-Corp is double taxation. So if I own a C-Corp and my business makes $100,000 a year, that C-Corp's going to pay 21%. So $21,000 essentially, oversimplify things, but $21,000 in income tax. Now, if I take that $100,000 out of the business as a dividend, now I have to pay at my personal income tax rate, so it's being taxed twice. Okay, right. So that's the biggest downfall. But if I'm at a high income tax bracket, okay, and I have a business that is pretty much just self-sustaining, and I may take a paycheck out of it as I would have out of any of my businesses, which is fine, but I'm not pulling a whole lot of money out of it. It may make a lot of sense to have a C-Corp in your portfolio. And beyond that, I mean, there may be some reasons for asset protection purposes. You want to talk to your attorney, but from a tax end, sometimes it may be good to have a C-Corp in your portfolio.
So basically, I think if I understand what you're saying correctly, if you're the type of person that's building a business and you're going to a lot of us entrepreneurs, we build a business and we don't really take a bunch of money out of it every year. We leave it in there. Then that's really good for a C-Corp environment. But if you're the type that's going to take it all out, you probably shouldn't necessarily use a C-Corp for that activity or for that income that you're going to take out.
That is correct. Yeah. And for most people that have a small business, they're constantly pulling cash out. And so they're constantly taking draws out of their business, and so a C-Corp would not make sense for them. Plus, of course, we have the compliance side, your shareholder meetings, all these other types of things that you have to do in a C-Corp environment you may have to not have to do in a disregarded entity LLC, for example.
Can you drill down just a little bit more on the cost segregation and kind of just give us some examples of how we could take advantage of the cost segregation?
Sure. So cost segregation is, and this isn't something that is new with this particular tax Tax Act that we're dealing with.
Well, it's not new, but it seems like they're doubling the.
Correct. So you're right, Tom. So with the doubling of the accelerated depreciation to 50%, 100%, it would make a lot of sense. And you can make the election on whether or not you do or don't want to utilize it.
If I don't do it this year, can I do it next year?
Yeah, you can. Right. Because
Okay,
cost
so I can
segregation is done.
Push that down the.
Right.
the
Well,
road.
you make the decision in that year. So I'll give you an illustration. Let me first kind of explain what cost segregation is. Generally, cost segregation is you bring in somebody from the outside, and there are businesses out there, firms out there that do this. So you bring somebody from a firm in to take a look at a property, and they go through and they break that property into its components, into its depreciable components. So if you walk into a property, sometimes people go through and they buy a property with some furnishings in it, for example. Okay, so when it comes into cost segregation, they come in and they're able to peel away things that aren't necessarily fixed to the walls that you have to depreciate over 27 and a half years, for example. So they begin to peel some of those things away. And so then you break things into their individual depreciable classes, and then you can accelerate the depreciation on those components of within.
Well, let's just give you an easy softball here. So I own vacation rentals.
Mm-hmm.
So let's just say all the furniture that I purchased for those vacation rentals can now be depreciated in like a 1 year period of
Well,
time.
the cost segregation is going to be more. So say, for example, I go and I buy a furnished property.
Okay.
So for those of you out there that might buy a turnkey property that's already furnished. Okay, and so you go through, and a lazy accountant will go through. Okay, you paid $150,000 for this property. Okay, I'm going to say $125,000 for the property, $25,000 for the land. Okay, and then that $125,000 gets depreciated over 27 and a half years. Okay, to where if you can go in and say, okay, well this particular piece of furniture is valued at this. Okay, and there are times you can go in, appliances, for example. Okay, it's not fixed to a wall. Sometimes you buy a house that has an appliance in there, for example. But it's trying to determine what is the value of that particular appliance, and then take the accelerated depreciation on it. So you basically take the house into all their individual components. So things that can be depreciated over a shorter timeline are basically things that are not fixed to the wall or fixed to the floor. So anything that's not fixed to the wall or fixed to the floor, you can cost
So with
segregate.
vacation rentals, where does the furniture lie? Is that just a normal expense, or is that a depreciable asset?
Your furniture generally be a depreciable asset.
Okay.
Mm-hmm. Yes.
So that would apply in this
That
case
is correct.
for double or quicker depreciation.
Correct. So you're going to depreciate it, even if you don't take the full 100% depreciation, you can then take it and depreciate it over a shorter timeline. So you might be depreciating that furniture over 5 or 7 years, and there might be elements, leasehold improvements, for example, that you may be able to depreciate over 15 instead of over the long.
Yeah, I do know a lot of people that listen to our podcast do have vacation rentals, and we just talked to Jim the other day. He's got a couple of those as well. Walter, a lot of people that we know, Mary Hart, have a lot of vacation rentals. So just be careful with that. Don't just add that to the basis of your property. So, which a lot of bookkeepers might want to do just because it's easy. It's kind of part of their process. So just kind of keep that in mind.
Awesome stuff. Well, anything else you want to add on to that?
No,
Just wrapping that up.
Sure.
Okay.
Sure.
Awesome stuff. No more questions?
Not as far as that's concerned.
We could go a lot deeper, but we're
going to get into some more
there,
good news for this tax law that came out as well. I'm excited.
Right. So let's talk about retirement accounts. Let's kind of switch tracks.
Sure.
Going into that. So I actually just opened my first Roth IRA at the end of the year here, along with the help of Tom, and so that's exciting, right? So
So if you ever
retirement
ask Josh a
accounts.
question, make sure you let him know it's a Roth IRA that you're talking about.
Roth.
Yes.
Oh, this for somebody in my seat.
For some reason,
yeah.
every time I talk to him, he assumes it's always a traditional, and I'm like, why do you? I don't want it traditional. I want everything in a Roth if I possibly can get it in a Roth.
Right. So let's talk about that. Retirement accounts. What do you got for us?
Okay. And so for this, there's nothing really new in the that we're seeing as it relates generally to retirement accounts. But this is one area that you can really balloon a lot of wealth in a short period of time, but it's something you have to be patient with. Mm-hmm. So a lot of times people want that money where they can touch it, they can do whatever they want to with it, which you can't always necessarily do in a retirement account. Another thing that we'll see a lot of times, people think that retirement account, I'm going to invest in the stock market, or I'm going to buy some bonds or whatever in my retirement account. So I'm going to contact one of these big companies, or contact my local broker and set up my IRA account. Okay, but there are a million other things you can do out there. And in the world of real estate, a lot of our clients utilize, and a lot of places that we go and speak and people that we network with use self-directed IRAs. And maybe not spend a whole lot of time on that, but that gives you the opportunity to be able to purchase real estate, to be able to lend, maybe to invest in some notes, to do some other things, other types of investments in your retirement plan, and you have more control over it. Now, you can't go through and you can't run an active business out of your self-directed account. So there are a lot of things you can't do. There's some rules that relate to related parties and things of that nature. So you have to be aware of those types of things, and that's why you have a custodian, somebody you'll connect with. Your accountant hopefully knows the rules, but also a custodian that you'll connect with that you can have a conversation with. If it's something you're trying to look into doing. But if you have a bunch of money in sitting in an existing retirement account, and you're a little bit nervous with the stock market, there are other options out there. But let me kind of at a real high level kind of go through as far as retirement accounts, and because there are a number of different types. You have a traditional IRA, okay, and a lot of people think when they think of an IRA, they think of a traditional IRA. I can put in my $5,500. This year it's going to increase next year to $6,000 if you're under 50, a little bit more if you're over that. And I can go through, and if I don't have another type of a retirement account, I can deduct it on my income tax return, and then later on, when I start drawing out after I come of retirement age, then at that point it's taxable. So you're deducting on the front end. So say for example, I put $5,000 in there, I never touch it. It goes into wherever, and 20 years from now, it is worth, that $5,000 is now worth $10,000. Well, I took the $5,000 deduction now. When I take the $10,000 out, I'm paying taxes on the full $10,000. So that's a traditional type of an account. Or I have a Roth account. So I can have a traditional IRA or I can have a Roth IRA. The beauty of a Roth IRA is I put my $5,000 in this year, but I don't take a tax deduction for it. Okay, I let it sit there. 20 years from now, it's worth 10. I take the 10 out. Guess what? I don't have to pay taxes on the 10. Mm-hmm. Okay, so you have a traditional.
It's worth $1 million.
But you can do that, and if you're a smart guy like Tom, he can do those types of things. So. So those basically your traditional IRA, Roth IRA. So if you're married under $189,000 a year, you can invest in a Roth account. If you're over that, you may need to look into something that's called a backdoor Roth. I'm not going to spend much time on that, but be aware that, because some people think, I make too much money to be able to invest in a Roth IRA. That's not true. You can't put the money into a traditional IRA and then do a backdoor into a Roth, and to be able to go ahead and utilize the tax code as it's there. So,
well, two things though, right there. So there's two things. The one thing is, if you're going to do the backdoor, make sure you do it in the same year.
Yes.
So and to me, it just makes it easier from a taxation standpoint. They are actually going to start giving you a deduction now for even over $189,000. Is that correct? Yes. So they did change the law. It used to be if you made more than $189,000, you didn't get a tax deduction for the regular IRA contribution.
Well, if you had another type of a retirement account, that's where the caveat was.
Okay.
Yeah.
Okay, I thought it was that they just capped it. But basically, if you made too much money, you didn't get a tax deduction. But then if you did roll it into the IRA, the Roth, normally you would have to pay because you rolled it into the IRA. But if you do it in the same tax year, you're basically like not having to you're basically being able to take advantage of the same thing. So in essence, it's almost like just investing it right into the Roth IRA. So
it's just a multiple step process to work around the tax rules.
So just keep that in mind, understanding you know what you're doing, and don't make. I have actually made this mistake where I thought that the custodian knew that that's what the plan was, and they'd never actually rolled it over. So even though I told them up front, I didn't really go back and remind them to make sure. So I actually still do have a one traditional account that I haven't rolled over, and I may still roll it over at some point in time just to get it into the Roth environment. But I guess for me, I'm looking at if I have one regular account and I have a bunch of other Roth accounts, then I think it's a little different play on that. So anyways.
Tom, I want to stress that. We had a client come to us a couple years ago, and they had rolled over, basically switched custodians. And so when they switched custodians, and they had a whole huge portfolio of properties in their self-directed IRA, and the custodian ended up mixing everything in together. And so had to go through the work of trying to peel away what's Roth versus what's traditional. Yeah. And to Tom's point, make sure that they're clear, because just because you say I want this thing in Roth and you set it up as a Roth, I mean,
right?
Trust but verify, and then verify again, and then verify again. Okay, because and Tom's right. I mean, he ran into a situation there. It's kind of like we're beating our heads up against the wall, trying to figure out, okay, what in the world's actually going on here, just because the custodian, just didn't set it up right. So just make sure that that you're really keeping an eye on those things. Because that's a huge mistake. You set up a traditional, you're putting money in there thinking it's a Roth, and then you begin to draw down. This thing blows up, and now you end up maybe.
Well, I meant to put it into a traditional, but I meant for it to be converted into a Roth, like within a month after the initial contribution. So basically, like right now, you can take a deduction if you want. If you want on the traditional, there's no income limit on that right now.
Right, but it doesn't make a whole lot of sense because you go through.
Right,
yeah,
I get it. You're getting taxed on you're getting a tax deduction on the seed, and you're going to pay tax on all the crop. So, and I'd prefer to pay tax on the seed and not pay tax on the crop. So that's kind of like how I look at that. That's one thing I learned. That's one mistake that I made. The other mistake that I want to make sure that that everybody knows I made, that I don't want you to make, is make sure this is the time of year to start thinking, what accounts do you have? What contributions have you made this year? And make sure your accountant knows about them. So we just actually had to file an amended return because I forgot to tell Josh, and I just assumed, because he works with my bookkeepers, and my bookkeepers handle my personal and Pat handle my business, and I just assumed that they were just going to communicate this to Josh, and I didn't, and they didn't. So I actually had to file an amended return for that. Just make sure that you tell your accountant what you did. If it's an IRA, if it's 401k, whatever it is, let them know what you did that year.
So let me ask some bonehead questions about this whole scenario here. So just to understand, so you had your traditional IRA, which you contributed, which I assume you contributed more than what you're allowed to in the Roth. So that's why you wanted to backdoor into the Roth?
No, the reason is because if you make too much money, you cannot contribute to a Roth.
Sure.
So for some reason, they don't want you to contribute to a Roth. I don't know why. But if you make too much money, you cannot contribute into a Roth. However, at any time, you can convert a traditional to a Roth.
Gotcha.
There's no income limit on that.
Gotcha.
So basically,
you're not going from account to account. You're just switching the type of the account that it is.
No, you are going from account to account. So I'm investing into a traditional IRA, and then it's basically like a rollover. So it's rolling it from a traditional to that Roth that Roth account.
Makes sense.
Basically, every year I have to create a new traditional, and then they set up a new traditional account, and
you still have that same Roth.
Correct.
Right.
Okay, let me. We can touch on other types of retirement accounts out there. So, because that's not, you really can't do a whole lot. I mean, $5,500 a year, that type of thing.
Right. But that is so. Right. We didn't hit on that. So that's going from 55 to 65 in 2018.
No,
right?
5,500 to 6,000 if you're under 50.
Yeah.
6,500 to 7,000 if you're over 50.
Right.
So from 18 to 19.
Here.
Right. Right. A little bit unclear, but those were for me. I'll probably do, Tom, is clean these up for distribution.
Okay.
That way, instead of for.
So by the end of 2019, so starting 2019,
right,
we can go to 6,000.
6,000. That is correct. Okay. Yes. Mm-hmm. Yep.
If you're over 55, then it goes
over 50.
Over
right.
50,
you can. Right. It's $7,000 in 2019. Yep. Okay.
Which people might not think is a big deal, but I promise you, if you just play with the numbers at like 12% or 15%,
$500 makes a lot.
If you just play with those numbers over a 20-year period of time, and you're just investing $5,000, $6,000, $7,000, it is a massive amount of money.
Mm-hmm. Okay. For those of you out there who own businesses, let's talk about a few other options that are out there that you can utilize to put a lot more money into your retirement accounts. Okay. You think of a solo 401k, and this is not something I really hear talked a whole lot about, but a solo 401k, you can put in $18,500 a year plus. So it's not just, you think of normally a 401k, so you go and you work for somebody. Okay. And I can put in my, my 18 grand into my 401k. Okay, so you're kind of your person out there working for a corporation. That's generally what they do, and so they think this $18,000 thereabouts that they can put into their retirement account every year. A solo 401k is for a business owner that does not have employees, and they want to have a 401k plan. Now they're a little bit more expensive than other types of setup because you need to have somebody who works with you on it. So you have the paperwork and compliance costs. They're a little bit more expensive, but you can not only do you have that $18,500 that you can put in, but also you can put in up to 20% of either your salary or the net income of the business. So so you can essentially end up putting in $55,000 a year from a solo 401k plan into towards your retirement. Okay, and there is a Roth option there as well. So solo 401k is something else that maybe you want to consider. There's a SEP, which I really like for my clients. Now the problem with the SEP is there's no Roth option, but people can do rollovers with these. But a SEP, and it's the simplest way because it's just a simple form that goes into the IRS notifying you're setting up a SEP, and then just go to a custodian and set one up. Or if you're investing in the stock market, whatever, just go through and set up an account and say it's a SEP. It's that easy. You don't have all this paperwork. The compliance costs are low. You can put in $25,000 of your salary. And but one issue with the SEP is if you have employees, you have to put in the same percentages for your employees. So there is some tax strategy type stuff that you can do as far as maybe setting up a separate type of a business, that type of thing that you're able to utilize for your SEP, and to where you're the only employee. So there's some tax strategy items that you can do there. But bottom line, especially if you're a business owner and it's just you're the only employee or you're the only person involved in the business, that's there for you, and you can stock away 25% of your salary or 25% of your net income into a SEP account. Okay, and that's a business expense, so it's a write-off to the business, so you're not paying income tax on it. Okay, so instead of the $5,500 going into a traditional IRA, now you can put in up to $55,000 into a SEP account.
And I think everybody should be taking advantage of these as much as they possibly can, but the people that probably we find that take the most advantage of it are people in their older years that don't really need the income, they've been working for a long time. But I'm going to tell you, the people that probably should be taking advantage of this a lot more is the people on the opposite end of the spectrum. You just started a business. It's kind of a side business for you, and maybe you only make 10 or 15, 20, 100 grand a year on this side business, but these ones can really benefit you a lot more in the long run than somebody that's older and that has made some money. So just when you start looking at compound interest and how much you can actually save yourself and make yourself over the long run, the quicker, the younger you are when you start. If you were 20 years old, 25 years old and started these accounts, when you're 65, these things are going to be worth millions of dollars if you focus on them and actually invest them properly.
Okay. And last, I just have a note here on simple IRAs. So if you have employees, you can do company matching up to 3%. Or 2% of the employee's earnings if you're not matching. So in that cap on that's $12,000. So we have some of our clients that use simples, but so just a few options that are out there. Sure. But there is no Roth option for SEPs or for simple IRAs.
Gotcha. All right. Well, awesome stuff. We appreciate you sharing that with us and coming well prepared for that. So make sure you guys take notes. If you haven't already, make sure you go back. And then like Josh said, that we're going to adjust this a little bit, but then we're going to get that back to you so you could email me. If you're not watching on the Facebook Live, we'll actually leave a link in the comment section for you. But if you are listening on the podcast, just email me. You can just email podcast@goodsuccess.com, and that'll come to me, and I'll make sure that you get a copy of this. So let's talk about Tom. This is Tom. What Tom was super excited about. He when we were going over what we're going to talk about, I asked him like, what are some specifics that we want to ask Josh about, and he's like, opportunity zones. And we even talked about it on the podcast with Jim Ingersoll yesterday a little bit. So let's talk about opportunity zones. What's some information that you have for us?
Okay, opportunity zones. So what's the intent of this? What's the purpose of this? So the opportunity zones is a way to try to encourage investors to try to invest in some distressed areas. Where we sit is we're sit right now is in a city called Gary, Indiana. Gary, Indiana was really a booming city half a century ago, and lots of wonderful shopping. The infrastructure was wonderful, but in time, which unfortunately happens sometimes in cities, is we see kind of a tearing down for a lot of reasons. Okay, the city gets older, businesses start leaving, and you end up getting to the point like where Gary is now, where it's not a bad city. It just needs a lot of help. And so what a lot of the intent of what's being done here is to try to encourage people to invest in these areas. So basically what the power has been given as far as to decide where these zones are at has been given to governors, and they can look at basically, I think it's the bottom 25% of their basically the areas in their particular state that they can take a look at and say, okay, these are zones that if somebody comes in and invests in, we're going to give them some tax favor treatment. Okay, and I'll explain what that is, what that is here in a little bit. And at this point, they're giving a lot of liberty as far as to the management. There's not a whole lot of regulation as it relates to setting these things up. Because sometimes when you when something comes new, we're going to have this mound of paperwork we're going to have to go through. This pain in the neck process of trying to set up this fund. But it's actually just a single page document that's going to go in with the tax return at this point. And so it's going to be really rather simple to set up. Now, there are some issues, some things you need to be aware of. I'll mention here in a moment when you're operating these things. Okay, so like where we're sit here is in Gary. Now, not in this particular area where we sit, but if you go north of us, and if you look at 15th Avenue here in Gary, you go to the north of there, you start to see a lot of almost all the way across up to the lakeshore. Governor Holcomb here in the state of Indiana has basically set that apart as being an opportunity zone. Also, a little bit to the eastern part of the city, you'll see more, and then when you get up into Hammond, Robertsdale, up into the north part area, up through there, you'll see some areas there. If you're in Indiana, for example, you can go to the just search Opportunity Zones Indiana, okay, and it'll take you right to the Secretary of State's, the Indiana website where you can actually pull up the map. And most states have this. So whatever state you're in, just kind of do a basic Google search. And most of the governors on their sites have put, okay, these are opportunity zones with maps that you can kind of say, okay, well, I'm looking at a property, does this fit in an opportunity zone? So if you're an investor, you may want to consider setting up a fund, but it has to be done through either a corporation or a partnership. So you can't do it as an individual to try to set up a fund. It needs to be done through one or the other.
So when you say a fund, I just want to make sure a fund is just like part of your corporation. It's not like I have to set up a hedge fund or I have to set up a fund. Right. It is like it's just part of my work that I'm going to be doing now is going to be in this opportunity zone, right?
Right. The best thing to do, would be to set up a separate partnership or set up a separate corporation. That's
so
all it does.
Corporation would be C-Corp or S-Corp?
A C-Corp or an S-Corp, to where that's all it does, is invest in these opportunity zones. Now, the rule is that you have to have 90% of the assets in that particular fund have to be in opportunity zones. Okay, otherwise there's some pretty severe penalties. So if you're wanting to, for example, bring a group of investors in together, try to invest into an opportunity zone. Okay, you want to do that through a partnership or through a corporation. 90% of the assets held need to be in the opportunity zone. Okay, so kind of from a structural component, and then when you file the partnership or corporation return, there's basically at this point it's just a single page document that's going to go in Form 8996, so still in draft form, that goes in with the tax return to notify them, and basically it's just a bunch of questions.
So you don't have to do anything now. You just have to do something every year for your tax return.
Correct. Yeah, there's nothing you need to do on the front end. So it's just something you do with the tax return and when you send it in.
And that 90% is the minimum that needs to be the asset.
Exactly. If you drop below 90% of the investments in that fund or in that business being in the opportunity zone, then there are penalties there.
Okay.
Okay. So opportunity zones is a privately held and managed fund. So it's not like when you think of I have to go and connect with a broker or whatever the case may be to try to do that. It's not the case at all. So it's privately held and privately managed. A qualified opportunity fund is a corporation or partnership mentioned that it holds at least 90% of its assets in opportunity zones, and you'll complete this form as we mentioned. So what are the tax advantages? And a lot of it depends. It depends on how long you hold the asset. Okay. So first of all, the money going into the fund is money that you currently, so say for example, you have a property and you go and you sell it and you want to take the proceeds from that property and invest it in an opportunity zone. So it's not new cash. So it's not me taking, $100,000 in cash out of my checking account and going in and investing in this opportunity zone for deferred taxation of the capital. And I'll mention the other side here in a moment. So it is basically if I currently have some capital gain. So I have a property, I go and I sell that property and it's subject to capital gains, whether short-term or long-term. I can take ideally long-term capital gains. I take the proceeds and I put it into this fund, okay, that invest in opportunity zones. So what happens is if I hold that for 7 years, okay, then I get a stepped-up basis. And Tom, you mentioned earlier, it needs to be done by the end of 2019 because that's where the 7 years to 2026 when this thing expires. I get basically a stepped-up basis of 15%. Okay, and then if I hold on to the property for at least 10 years, I don't pay tax at all on the new appreciation from the time that I invest. So let me make it easy. I have $1,000. Okay, so I have $1,000 that I have in long-term capital gains from wherever. I don't care. I sold a stock. I sold a property. Whatever. It's considered long-term capital gains. I take that $1,000 and I put it into this fund. Okay, so I put that money into the fund on January 1st of 2019. So I put the money in that $1,000 in there. When it comes in, and of that $1,000, okay, that I have in capital gains, so I take that $1,000, and at the end in 2026, okay, at that point I'm going to not pay taxes on the $1,000 in capital gains that I put in there. I'm only going to pay taxes on 85% of that, or $850 of the $1,000, not on the full 1,000. Okay. Now, if I sell the property at any point in that in say to 2026, and I sell the property, I'm going to pay tax on the appreciation. So that $1,000 I put in, and I go through, and so I take the $1,000 I had in capital gains, but it came along with $30,000. That was the actual basis, and whatever it was that I sold. So I put $31,000 in there. Now I sell the property for $50,000. Okay, in 2026. Okay, so the $1,000 I'm only going to pay tax on the 85%, and then I'll pay capital gains tax on the rest.
So basically, you get a reduction for 1031 money a reduction of tax for 1031 money into the opportunity zones, or if you hold it for long enough, then you wouldn't have to pay any tax.
Right. So if I hold it for 10 years in this example, I would not pay tax at all on that other $19,000.
Right. So that is only an example of bringing 1031 money into the opportunity zones. And then on the flip side, what if it's new cash or just new investment into opportunity zones?
If it's new cash, then it's going to be, so there is no capital gain deferment. So basically, it just depends on how long you hold the property. So there's really not a whole lot of as much advantage there for new money coming in as there is for capital gain money coming in.
Okay, so let's just say I buy properties now in these opportunity zones, and I hold them for 10 years. Mm-hmm. I thought that for some reason I was thinking that if I hold it for 10 years, then I don't have to pay capital gains.
That is correct. You don't pay capital gains on it.
But I just keep at the same basis. I don't get a stepped up basis or anything. You only get a stepped up basis for the people that are bringing 1031 money in.
Correct.
Okay. So you do get an advantage because you don't have to pay any capital gains ever as long as you hold the property for 10 years. So if you hold the property for 7 years, do you get a discount, or do you have to hold it for 10 years with new cash money?
New cash money, right? The new cash money is going to be based on the capital, right? It's
10 years only. Okay. So the other piece of this is also businesses. So you don't have anything on here about that, but businesses almost have the exact same opportunity. If you go to sell a business, but you've got to hold it for 10 years, got to be housed in an opportunity zone area, which I think is the bigger play here. People aren't paying attention to, which in my opinion is why you're seeing brand new large investment of companies coming to Gary, Indiana, because I believe that they're setting up these new corporations, and they're saying, hey, we're going to sell this corporation in 10 years, and they're not have to pay any capital gains. So that's the other one to look at. The other piece of this whole thing is I believe this is going to do, and it plays in perfectly with what I've been saying is going to happen for 3 years, and I didn't even know that this was going to happen. So all these areas, there's two things. One thing is that some of these areas you just don't really want to invest in because you don't really want to invest in these areas. But there are some areas that, in my opinion, like Gary, Indiana. Gary, Indiana 10 years ago was really not a good place. But I think even if without opportunity zones, Gary was already kind of digging its way out of some things and having some positive momentum coming into Gary. But with this, a place like Gary, I think is going to totally change. It's a game changer for these sub 100, type property neighborhoods. It's huge. So who do I want to be? I want to always position myself in front of wherever progress is going to happen. Rockefeller made all of his money in not going to the gold rush. He went in his money by sticking himself right in front of the gold rush and saying, I'm going to sell you all of this. I'm going to sell you jeans. I'm going to sell you picks and axes. And that's how people really take advantage of these government programs. It's not the people that are getting involved in the actual government program itself. It's people that are putting themselves in front of those. So if you're a wholesaler, if you're a fix and flipper, if you're buying and holding, I can guarantee you that not in every area, but in a lot of these areas, like Gary, Indiana, I think we're going to see prices go crazy over the next 3, 5, 6, 7, 8, 9 years because they're going to come in and take up all the properties, and there will be a lot of demand then for a small amount of property. And what changes in real estate when there's demand? Prices go up. So you have to supply and demand are the two rules the one rule that will always rule over real estate in really almost any market, unless you have government intervention, right? So just please keep your eyes peeled for that and put yourself in front of these opportunity zones in a way that you can take advantage of it from all the crowds that are going to be headed to it. I was at a meeting last week. There was $10 billion raised in that meeting alone with fund managers and people in that meeting, and they don't even know the rules yet. So if you just think about that, there's a lot of money that's going to be facing towards these areas, and for good reasons. I think the business deduction is really big, and the real estate is going to be really big. So just keep an eye on that. So I appreciate you going into all that, Josh, in depth. But I would read as much as you guys can possibly read about this. There's a lot coming out. I think even some articles have come out recently from what the IRS is going to hand down on this. So if you're a new real estate entrepreneur, Josh, and you're trying to get into this, what do you think people should do?
Talking into opportunity zones or just in real estate in general?
Well, both, but yeah, I mean, opportunity zones or whatever. What do you think new people? Because normally it's like, we'll find a mentor, but you know what? Who's a mentor in opportunity zones right now? Like, nobody has any experience in this, so like, really, what should people be doing?
Yeah, I mean, for all of us, we're almost like pioneers, trying to figure this thing out. And it was literally just a few weeks ago that we received any sort of direction on some of the pieces of this, not just this, but also the qualified business income tax deduction. Mm-hmm. So, we spoke earlier this year. There's a lot of questions, and now finally in October they go through. I think I had mentioned that a publication had come out, IRS publication in regards to this, and 180 some odd pages. And I'm sitting there on a Friday night, actually before the mastermind, going through reading this thing, trying to get my arms okay, what's changed, and it was a grind of reading. So. But as far as Tom, you mentioned, as far as identifying, what opportunities are out there. So if you're a new real estate investor getting into this, getting yourself working together with somebody who has a drive to do these types of things, and because you don't want to kind of be the one kind of with a lot of this stuff trying to do it on your own. So get yourself networked with somebody who's doing this already and can help you through the process. But yeah, with these opportunity zones, some of it we're gonna have to wait and see how some of this plays out. As we get some things that will be finalized here in the coming months. But then in practical application for both sides of this within the next year, as far as how does the IRS actually interpret this, and then ultimately, I think in some ways we'll even see some of this tested in tax court. As of right now, though, it sounds like you either have to buy the business or start the business or buy the property by the end of 2019, unless they extend that. Like, that's really if you take the full advantage of it. Right. So that's something to be mindful of. 2019 is going to be a whirlwind in these opportunity zones all around the country. So because you're going to have to pay tax on that capital gain come December of 2026, we'd be on the return filed in 2027. That you're going to end up paying capital gains on it. So people want to take that full advantage of that full 15%. You're talking about 1031 money coming into this space. I feel like, to me, at least this is what I hear. I think there is some 1030 money coming in, and I think there is advantages for that. But there's more money coming in that's new, fresh money that they're looking for parking their money for 50 years. And if that's what they're looking to do, it's a great opportunity, for them. So question. So basically, what you're saying is they basically get the full benefit of being able to take depreciation throughout the time period of owning that house and taking that basis just like they normally would. They just don't have to pay tax when it has to go back. When they sell it. Right. So it's a big deal. This is a big deal, guys.
One thing you mentioned was that you say you're seeing corporations come into these opportunity zones and already start to sit down on these. Is that what you mentioned?
Oh, yeah. There's lots of money being raised.
Is it because they saw that in advance?
Well, no. We knew this. This law was passed like almost a year ago.
Right. Sure.
So this law was passed a long time ago, but the problem is they never clarified it. Sure. They never really gave us what the rules are. What I'm saying is like, I sat in a room and talked to these people. I'm like, I would feel horrible raising. Like, I'm the type of person, I can't raise money on something I can't like be able to stand on and know what I'm talking about.
Right.
And to me, like, I wouldn't be able to sleep at night if I had to raise money towards an opportunity zone without knowing the full details of what I'm raising money for. I have an integrity issue with that. But now that we kind of know a bit more about what the details are, like, I'm all for this, and I probably need to set up. I don't know. I'll talk to Josh about if I should set up, but what if a partnership probably is what I'm thinking right now, to just particularly go after these in my own portfolio, because we're buying them already right now, but they're in our regular corporations because we didn't really know what we needed to do. So, well, I sat in a meeting a couple months ago with somebody from the state that kind of oversees some of this, and he was saying that there's already,
tons of money being raised, as you were saying, that's just kind of sitting there waiting.
So it's being raised, but the properties haven't been purchased yet. That's
Yeah,
the
they
thing.
haven't
So
deployed.
like I'm telling you, 2019 is going to be an absolute whirlwind in these areas. If you're not in opportunity zones, you need to be looking at it from at least a wholesaling perspective or something, because it's going to be worth your while.
And you better spend some of your Christmas holiday trying to identify properties. You want to get ahead of the.
So, question: What if you already purchased a property this year? Let's give me an example. We have a company called Olson Group, and it's one of our development companies, and we buy houses and fix them up, sell them, own them, rent them, transfer them to other entities to hold long term. So if we've already purchased properties, how does that particularly look? Could I transfer that into this?
Right. You're gonna need to move it into.
So we think that could be an option. So I could move those into the qualified new partnership if we set that up. Okay.
Yeah, and you have the normal, as far as handling of the taxation, as far as doing that transfer. But yeah, you'll want to, because it needs to be, handled as a sale and go through all that process, moving it from one entity to the other.
Sure. Okay. Well, that probably something we need to go over, Josh. So
Yeah, I think you guys are going to be having some extensive conversations here in the next couple weeks or so, maybe. Yeah. So.
And to be honest with you, I do not have a whole lot of clients that are expressing any interest in this. Because I think it's just complicated, and a lot of times, people operate out of fear. They're kind of scared. And as far as, okay, what am I getting into? Or they just, like, oh, I don't know if I, the kind of the old way of thinking, I don't want to invest in these areas, that type of thing.
Sure.
And they fail to see the opportunity that's there.
Sure. Opportunity in the opportunity zones. All right, so we're gonna have to wrap this up. It's been a long podcast here, but it's been great. A lot of great information. So make sure you guys again are taking notes. But to wrap this up, so people just getting into real estate, they're just now jumping in, or this could even be good information for people that are already in real estate. What are some things that they should know going into this next year, 2019?
Well, I think first of all, you'd mentioned some people. You mentioned Jim Ingersoll, for example, great guy. These podcasts, he has one. You have the good success. Spend your time getting yourself educated. So much free information out there, and just be listening. There's a world of just bad information out there too. Yeah. But watch who you're listening to. But get good advice, and be listening. And if you're going to get into this, as Tom mentioned at the front end of the podcast, getting people in your network, as far as that you can bounce questions off of. So many times we see people, they go through and they try to do something alone without getting advice, and they get themselves in all kinds of trouble. So whether it's setting up their entity and trying to do it themselves and not using an attorney or somebody to help them get it set up, or getting them, going and getting it set up the right way, but not setting up the right tax structure. So before, and I don't care if it's in real estate or in anything, make sure you sit down, get yourself in a room where you're talking to people and getting yourself educated before you start throwing your money after something.
And you know what, too? Like, things change. So, like, what might have been the best entities for you 5 years ago isn't the best today anymore. So, like, you got to stay up with that, which means you have to stay in a good network, which is why the Good Success Mastermind is an absolute awesome place for you guys to be able to be connected with those people that are keeping up with the changes and knowing what's happening, and knowing the new laws and new accounting changes and everything. So, keep that in mind.
Yeah, absolutely. So one thing I want to wrap this up with, and I was gonna eliminate this, but I actually want to hear what you have to say. And this is nothing to do with taxes, nothing to do with opportunity zones or retirement accounts or anything. But this is something that we kind of started after our first podcast with you last year. So, and you said you listen to our podcast, so you may be knowing what's coming up here. So, good success to us. You know us very well. You've been a part of our mastermind for a while now. You know me personally. You know Tom personally. So when you hear the term good success, you know our message, you know what we're all about. What comes to mind for you? What do you think about when you hear the term good success?
The first thing that comes to my mind is almost a business family. And not only do you kind of get to know these, the ladies and gentlemen in the room from a business end, but you almost kind of get to know them personally. Sure. And so it allows you, I think, more than anything, and I think who was just recently talking about being vulnerable. I think it was Jeff, right? Jeff Johnson may have been talking about being vulnerable, be willing to be vulnerable. And so it allows you to get into a place to where you can feel comfortable, and you're in an environment to where, first of all, they share your core values. You mentioned every podcast, what are the core values for good success? And for the individual, think of my core values, knowing what those are, and they align. And so you get into a room, and then you have these individuals that not only are they wanting to try to help you on the business side, but also you can be vulnerable if you're having a personal issue as well. And whether it's praying with you, phone call, whatever the case may be. It could be maybe a struggle in some area of your personal life, maybe as a parent or as a husband or as whatever the case may be, to where you can have a conversation with them. I mean, for you, Josh, you had a guy from the mastermind flying for your wedding.
Yeah.
And so really it becomes almost a family, a group of trusted advisors that you can lean on. And I think more than anything else that for the Good Success Mastermind, because it is, of any of the rooms I've been in, by far and away the most humble group, which I think is key, is instrumental. The humility is there, allow you to be vulnerable, understanding that what we all have areas that we're struggling in, to be able to have that conversation and to be able to not only get the help you need, but also to help others as well.
Sure, absolutely.
So that's what the Good Success Mastermind is all about, and thank you for giving us that. But just the term good success, just like the whole, what do you think about when you hear the term or those two words together, good success?
Really, good success. I think ultimately having good success is what is the legacy that you leave behind. So as far as having good success, what we think may be good success now or success now may not be good success in perpetuity. So when I think of good success, I won't know whether or not I've obtained good success, and I may never know in this lifetime. A lot of it will play out in my children and my grandchildren, that second and third generation. What have they done, or what did they do with whatever sort of path that I tread? And that's where true success is. What sort of legacy did I leave behind? Who are the people that I impacted?
Great stuff. Love it.
Awesome.
All right. So I'm not going to forget this time, but your contact information. So if somebody wants to reach out to you, I'm sure that people are going to have all kinds of questions. You even mentioned that, if they have their own CPA, their own accountant, that they need to reach out to them. Definitely. But, maybe somebody has specific questions about something we talked about on the podcast here. Website, email address, phone number. What's the best way to get in contact with you?
Sure. Feel free to email me. I have a Facebook page. Send me a friend request, a message, whatever the case may be. I have a business page as well. I don't use it all that actively. My office phone number 219-365-9520. Belk Associates LLC is the .com is the website, or you can email me jbelk, letter JBLK at belkassociatesllc.com.
Awesome stuff. And we'll make sure that we'll leave that in the comment section there. And then when the show notes do come out, which are going to be coming out very soon, be on the lookout for that. We'll make sure that we have that listed there. Josh, it's been awesome. Thank you for taking the time to sharing all this information with us and the audience. And we'll have you back sooner than a year this time. So it'll, we're going to 2 podcasts a week now. So we'll definitely have you back very soon. So. Awesome stuff.
Awesome.
So
thank you for coming. Josh.
Yes, sir. And come into the office, by the way. So that was great having you here, hosting you here. Awesome. All right, so that's going to do it for today's episode. We appreciate you jumping on and joining in with us. If you haven't already, make sure you have subscribed to the podcast. We're on all the podcast platforms. Just go search for us. And then leave us a review on Apple Podcasts if you would be so kind. 5 stars would be amazing. Leave a review. Let us know what you think of these podcasts. And then one thing that I didn't mention is if you do want these notes, you can email me. Josh is going to get me a PDF. If you're watching on Facebook right now, then we'll have the link to this document in the comment section. But if you're listening on the podcast, then you can email me podcast@goodsuccess.com, and that'll forward to me, and then I'll make sure that you guys get these notes that we have in front of us that Josh provided. And then the Good Success Mastermind coming up February 4 through 8 in Dallas, Texas at Quest Trust Company's office. They're kind enough to host us down there, and you can learn more about that at goodsuccess.com/mastermind. Fill out the application there, and then you'll chat with either myself or Tom Olson, and we'll kind of vet you, like you said, about the core values in the group that we have. Obviously about your business, but also you as a human being and as a person. So one more time, goodsuccess.com/mastermind is where you can learn about that. And then the Active Turnkey book, again, this is going away January 1. We are taking this off the shelf for you to get it for free. It will be still available on Amazon, where you can pick that up for $14.99. But you can get this for free as opposed to $14.99. Just go to atkbook.com. Tom's going to pay for the book himself, and then we'll get that shipped out to you. All you got to do is cover shipping and handling costs, and you can take advantage of that. So atkbook.com is where you can do that. Community Go-Giver tickets are already on sale. Early bird pricing. Josh is going to be speaking at that on day 1, June 26, 27, 28. So make sure you take advantage of the early bird pricing tickets, and you can go to communitygogiver.com and check out there. That's going to do it for today's episode. We appreciate you jumping on. Remember to be a conduit and not a bucket.
Work to have to give.
And we'll catch you on the next one.